Ladies and gentlemen, OG John AG here, and I need you to understand what just happened. Because this is not normal price action, this is not a gentle trend continuation, this is a violent market dislocation that occurred after the regular session closed. Silver just exploded to $106.55 on the Globex Open. Let me repeat that. 106.55 on the electronic overnight futures market. This was reported by credible precious metals accounts tracking live data, and the move was so explosive that traders are calling it a gap and run scenario. I will never ask for your money, never pitch invest with me, never run paid signals or funds. Protect your capital. Stay far away from scams using my name. Now here is why this move matters more than any slow grind higher. Globex is the CME Group's electronic trading platform that runs nearly 24 hours. It is where institutional players, foreign buyers, and algorithmic systems operate when New York and Chicago pit traders have gone home. And when you see a price explosion on Globex Open, it tells you something critical. It tells you that demand showed up with size and urgency when liquidity was thin. It tells you that someone, somewhere, needed exposure immediately and was willing to pay up to get it. And in precious metals, where the vast majority of trading is paper contracts with no intention of taking delivery, a move like this signals that the gap between paper price and physical reality is starting to crack. Connect the dots with me for a second. Over the past 18 months, we have been tracking COMEX registered silver inventories. Registered means available for delivery against futures contracts. That number has been hovering near historical lows, while open interest, the total number of outstanding contracts, remains elevated. At the same time, premiums on physical silver coins and bars have been persistently high, sometimes $4 to $6 over spot for U.S. retail products, and even higher globally. Dealers have been struggling to source material. Mints have been running behind on orders. And now, on a Sunday evening Globex session when most retail traders are not even watching, silver rips higher by multiple percentage points in minutes. Let me ask you a simple question. If silver is just an industrial commodity with abundant supply and no monetary premium, why does it behave like this? Why does it gap up violently in off-hours trading when liquidity is supposed to be thin and moves should be muted? The answer is because the narrative you have been sold is a lie. Silver is not abundant. The above-ground stockpiles that used to buffer supply and demand imbalances have been systematically drained by decades of industrial consumption that exceeded mine production. And now, with solar panel installations doubling, electric vehicle production ramping, 5G infrastructure build-outs accelerating, and military defense applications consuming silver at record rates, the deficit is not some future projection. It is current reality. Here is the technical picture that makes this move even more significant. Silver had been consolidating in a range between $100 and $104 for the past week. It was building energy, coiling, setting up for a breakout. Traders who understand chart patterns were watching for a decisive move above 104 with volume confirmation. Instead, we got an overnight explosion to 106.55. That is not a breakout. That is a short squeeze, a supply panic, or a large institutional buyer stepping in with urgency. And when these moves happen outside regular hours, they often signal that the real action is just beginning, because the paper market structure is showing stress fractures. Now let me take you into the mechanics of why Globex moves matter. During regular pit trading hours, there are market makers, authorized participants, and bullion banks that provide liquidity by taking the other side of trades. They smooth out price action, they absorb temporary imbalances, they keep spreads tight. But on Globex, especially during off-peak hours, that liquidity thins out. The number of participants willing to provide two-sided markets drops. And when a large buy order hits the system, there are not enough sellers at the current price to absorb it. So the price gaps higher, sometimes violently, until it finds a level where sellers are willing to step in. What does that tell you? It tells you that at $103, $104, there were not enough willing sellers to meet the buying demand that showed up. Think about that. At prices that are already near all-time highs, buyers are still chasing. And if this is happening in the futures market, where contracts are mostly cash settled and never see physical delivery, imagine what is happening in the physical market where industrial users, sovereign buyers, and large stackers are competing for actual metal. Let me connect this to the broader geopolitical picture because nothing happens in a vacuum. China has been systematically restricting exports of critical materials for months. Antimony export controls went into effect. Gallium and germanium exports were curtailed. There have been ongoing discussions about potential silver export restrictions because China understands that silver is not just a monetary metal, it is a strategic industrial material essential to modern technology, defense systems, and energy infrastructure. If China, which is both a major producer and the world's largest consumer of silver, decides to limit exports or prioritize domestic stockpiling, the rest of the world faces an immediate supply crisis. At the same time, the United States is reshoring manufacturing under bipartisan political pressure. Tariffs on Chinese goods are not going away. The CHIPS Act is funneling billions into domestic semiconductor production. The Inflation Reduction Act is subsidizing solar panel manufacturing and electric vehicle production on American soil. Every single one of those initiatives is silver intensive, and the supply chains to support them are not built yet. So you have surging demand from policy-driven industrial build-outs colliding with constrained supply from geopolitical fragmentation. That is the perfect setup for price dislocations like what we just saw. Now let me give you the bearish case, because I am not here to pump hopium. I am here to give you the full picture. Volatility cuts both ways. A violent move higher on thin Globex liquidity can reverse just as quickly if the buying pressure was temporary, or if it triggers profit-taking when the regular session opens. We have seen flash spikes before that got sold back down within hours. So the first risk is that this 100-655 print does not hold, and we see a pullback to retest support at 100 or even lower if stop losses get triggered. Second risk, central bank intervention. Not direct selling, because central banks have been net buyers of gold and strategic hoarders of silver for national security reasons, but intervention through their proxies, the bullion banks. If a concentrated short position from commercial banks gets threatened by a sustained rally, they have tools to suppress price through coordinated futures selling, media narratives about bubble risk, or regulatory changes that make physical ownership more difficult. We saw this playbook in 2011 when silver hit $49. Margin requirements on futures contracts were raised multiple times in a matter of weeks, forcing leveraged longs to liquidate, and the price collapsed. Third risk, liquidity crunch. If we get a broad market deleveraging event, a credit crisis, or a sudden shift to risk-off positioning across all assets, silver can get hit hard in the initial panic, even if the long-term fundamentals are bullish. March 2020 taught us that lesson. Silver fell from $18 to $12 in 2 weeks because leverage players were forced to sell anything with liquidity to cover margin calls elsewhere. It does not mean the thesis is wrong. It means that in a true liquidity event, correlations go to 1, and everything gets sold except maybe government bonds and the dollar. But here's what those bearish scenarios do not change. The Silver Institute's most recent data showed annual deficits around 100 million ounces, when you account for all industrial, photovoltaic, jewelry, silverware, and investment demand against total mine supply and recycling. That deficit has to be filled from above-ground inventories, and those inventories are not infinite. Every year the deficit continues, the cushion gets smaller, and when that cushion runs out, when there is no more buffer stock to draw from, the price does not adjust gradually, it spikes violently, because industrial users cannot shut down production lines. They will pay whatever it takes to secure supply. Here's the mid-video reframe that changes how you should think about what just happened. That 106.55 spike on Globex is not just a price move, it is a signal. It is the market telling you that the paper pricing mechanism is breaking down. For decades, the price of silver has been set by futures contracts traded on COMEX and LBMA, where the vast majority of participants never take delivery, they just trade the contract for profit or hedging purposes. But what happens when physical buyers start demanding delivery in size? What happens when the registered inventories available to satisfy those delivery requests are not enough? You get backwardation. You get a situation where the spot price or near-month futures trade at a premium to longer-dated contracts because people are willing to pay more for metal now than metal in the future. That is the opposite of how commodity markets normally work. In a normal market, futures prices are higher than spot because of carrying costs, storage, insurance, financing. But when physical supply is tight and buyers are desperate, the curve inverts. And we have seen intermittent backwardation in silver over the past year, brief episodes that got dismissed as anomalies. But anomalies do not keep happening unless there is a structural issue underneath. So what you witnessed tonight on Globex might be the early warning of a delivery squeeze. It might be large buyers realizing that if they wait, there will not be metal available at any price. It might be sovereign entities securing strategic stockpiles before export controls get announced. It might be industrial users panic buying because their supply chains are at risk. Or it might be a combination of all of the above. The point is, this is not speculative froth, this is not retail FOMO, this is institutional urgency in a market that is supposed to be stable and liquid. And here is where it gets really interesting from a trading and positioning perspective. The Commitment of Traders report, which tracks futures positioning by category, has shown for months that commercial traders, mostly bullion banks, have held large net short positions in silver. Those shorts are supposed to be hedges against physical inventory or producer obligations. But the concentration of those shorts in a handful of large banks has raised questions about whether they are legitimate hedges or market manipulation. JP Morgan paid $920 million in fines in 2020 for spoofing precious metals markets. That is not conspiracy theory. That is legal settlement fact. If those concentrated shorts are now underwater after tonight's move, if they are facing margin calls or risk management pressure, they have two choices. Cover the shorts by buying back contracts, which would accelerate the rally, or double down and add more shorts to try to cap the price, which increases their risk if the rally continues. Either way, the setup is asymmetric. The upside if the physical market truly decouples is exponential. The downside if the paper suppression continues is what? A retest of $100? Maybe $90 if there is a broad market washout? The risk-reward for holders of physical metal or long-dated call options is compelling. Now let me give you the historical context, because people need to understand that what is happening now is not unprecedented, but the scale and the drivers are different. In 1979 to 1980, silver went from around $6 to $50 in months during the Hunt brothers accumulation. The Hunts were trying to corner the market, buying physical, taking delivery, and forcing a short squeeze. The exchange changed the rules mid-game, raising margin requirements and implementing position limits that targeted the Hunts specifically. The price collapsed. But here's the difference. The Hunts were a concentrated, identifiable force that regulators could target. Today, the buying is diffused across sovereign nations, industrial users, retail stackers, and institutional allocators. You cannot change the rules to stop China from hoarding or Tesla from building battery factories. The second parallel, briefer but worth noting. In 2011, silver peaked at $49 before a multi-year correction back to $14. What killed that rally? Coordinated margin hikes, a stabilization of the European debt crisis, and a broad rotation back into risk assets as central banks launched unlimited QE. Could we see a similar pattern? Yes, if central banks somehow manage to engineer a soft landing, bring inflation down without recession, and restore confidence in fiat currencies. But ask yourself, is that likely given current debt levels, deficit spending, and geopolitical fragmentation? Because I am not seeing it. 3 key takeaways from tonight's move. Number 1, the 106.55 Globex spike is not just volatility. It is a symptom of structural tightness in physical supply colliding with paper market mechanics that were designed for a world where supply was abundant and demand was stable. That world no longer exists. Number 2, the risks are real, volatility will continue, and anyone holding physical or trading futures needs to be prepared for drawdowns, fake-outs, and emotional tests. But the long-term trajectory is set by fundamentals that cannot be wished away. Number 3, the paper market and the physical market are diverging, and when that divergence becomes unsustainable, the snapback will be violent and fast. Here is the unresolved tension I am leaving you with tonight. We do not know if this Globex spike holds when the New York session opens tomorrow. We do not know if this was a one-off surge or the beginning of a sustained breakout. We do not know how bullion banks will respond, whether they will cover shorts and capitulate or add to positions and fight. What we do know is that the setup has never been more asymmetric, the fundamentals have never been more supportive, and the gap between paper price and physical reality has never been wider. So verify what I have told you. Check the Globex data yourself, look at the inventory reports, track the premiums, follow the geopolitical developments, and make your decisions based on evidence, not emotion. This is your capital, your future, your responsibility. Invest with logic, not hype. OG out and about.